with or without all these tax hikes, corporate America keeps growing. So if we actually have this scenario, this is guesswork, but when you're making putting a portfolio together and making a guess for the next 10 years, I kind of like where this guy's going. So again, the market is all opinions, right? And Steve and I will argue every day about a stock. We love it, we hate it, we're buying it, we're selling it. That's the market every day. But when an influencer like Jamie Dimon, who I think is a pretty smart guy, says these things, I get pretty excited, because that will give a pretty good runway to where the market could be 10 years from now. And when we're thinking about investing, I think short. I know we all like to think, okay, like you saw the comment I made about this thing that Steve Weiss talked about a couple of months ago, right? We all want to have stocks. Anyone buy Vuzi, by the way? Besides Steve and me? Nobody bought it. Remember when Steve Weiss was on in February, though? And he went for the whole hour, and at the end, somebody asked him, well, give us a stock pick. And he says Vuzi, which makes these AR type glasses. And the stock, I don't know, was at 1281 that day. And I looked at it and I said, I don't know. Then it was lower the next day, then higher the next day. And then Steve and I both bought it at various prices. And all of a sudden they started getting these contracts, and the volatility on the stock and the beta. So the market move in this stock more than the market really picked up. So you wake up from February 4th to April 7th, the stock's gone from 1281. I think it closed yesterday.
It's 30-ish.
Yeah, 30-ish. And between that, they did a big secondary. So let's talk about that for 30 seconds. So when a company announces a secondary stock sale, like I talked about GameStop, if you read the morning notes in GameStop 2 days ago said, and this is after, and well, we'll get into that in a minute, but GameStop said, I think Sunday night actually, okay, we need to sell a bunch of stock to fund our future, to move everything online, no stores, e-commerce, all that stuff. And the stock was, I don't know, between 170 and 180, and I think it's still right around there. But typically when companies say that stuff, the stock trades off because buyers want to buy that batch cheaper. So typically when you get it, so after 4 o'clock, typically companies come out who want to raise capital. They say, all right, we're going to sell a million shares, 2 million shares, a billion shares, whatever. And then they spend that night syndicating the shares to who they think they're going to buy it. Now, the funny thing about GameStop is that last week, I don't like picking on GameStop too much, but last week, beginning of last week, Jefferies raised its price target from 25 to 175. But the average price on GameStop, I think, is 40. So guess who the and Steve, I know you've heard all this stuff before, but guess who the underwriter is at an at-the-market offering of GameStop shares? Jefferies. So they have the highest price target. The woman who wrote the report, really interesting, says it's worth 4 times sales. We talked about this versus Ronzoni last week, which traded at less than 1 time sales. And I have a feeling right now they're trying to market the GameStop shares to try to find institutions who will buy like 1 million shares or 500,000 shares or 20,000 shares, or whatever the number is. And because they haven't back and told the market they're done yet, like the deal's done, I'm getting more suspicious by the day. So I know the stock hasn't come off a lot, but my suspicions are telling me that the average institution, like a Fidelity or a Franklin or one of those people, is saying I'm not even close to your price. Whereas when Vuzi did theirs, Vuzi, the stock was at 27 or 28. They announced a huge secondary. The stock goes right to 20 or 21. The whole deal gets done in like 30 seconds. And now it's back to 31 already. Very different can of worms. So I really, and I see that Casey, your boy Ryan is now the chairman and all this other stuff. And, they're trying to morph their way off to e-commerce land. But I think the average Wall Street analyst is very skeptical about this. And the average portfolio manager is even more skeptical. So what Jeffrey's may be reduced to doing is to try to do this with hedge funds and enrich individuals and family offices rather than the mutual fund types. So it's not over yet, but I have a sneaking suspicion it's not going to end very well. We'll see. We'll see. And it doesn't mean if you own GameStop, you're supposed to sell it tomorrow. It just means here's a data point that may or may not happen, and just be aware of it. And always in your portfolio, when you're like, if you own a lot of stocks, if you own more than 5 or 10 stocks, you should check the news, and you see something moving around a lot, you should really understand and check the news so hey, it's a secondary. Hey, they had earnings. Hey, the CEO resigned. Hey, what's the news? Because stocks just don't move for any, for any random reason. There's always these reasons behind them. And if you're going to be a single stock buyer, which is the riskiest thing to do, but that's what we talk about here. You really got to pay attention to your portfolio, not once a month, but at least once a week, and better off once a day. If you're in mutual funds and ETFs, you don't have to do that so much. But if you're going to own single stocks, like the stocks we're talking about, like Vuzi or Ascensius or GameStop or whatever, you got to keep kind of a close eye on these things. And, it should be fun. It should be, educational. And hopefully you're going to make some money at the same way. But I wouldn't, and I go back to this time and time again, be very careful about thinking you're going to make 100%, every month on every stock. We did that on Vuzi, but I could point out 30 losers that I have also. And that's why I have a diverse portfolio. So one company or one stock just doesn't bite you really hard. Another thing you want to think about, I know some of you, particularly students, are going to work in corporate America, big companies, and a lot of these companies want you to buy stock, or they have a stock ownership program. Just think about, you're working at American Express, you're working at Pfizer, you're working at Jeffries. So you're getting paid by this company. Now you're an investor in this company, and all your net worth ends up being tied in this company. Now, this could be so we have a guy from Netflix. For him, it's a really good thing. But the company Steve and I worked at years ago, Drexel Burnham, it was a really bad thing when the company went bankrupt. So if you're working for a really good company, that's great. But make sure you are a little bit diverse in your thinking, and maybe not want to have all your eggs in one basket, even at a Pfizer or companies like that. Just a thought. Right, Stevie?
Sure.
All right, so let's go to the anti-Jamie Dimon. Let's go to this guy, Jeremy Grantham. So in terms of people I like to read, Howard Marks would be number one, but I love to read what Jamie writes. And this guy, Jeremy Grantham, if you Google this guy, he's the chairman of a company called GMO, and he writes once a month, and he's a complete bear. So we're all pretty bullish. I guess we are, and maybe we're not, but we all think the market's probably going to do okay here. This guy is the exact opposite. He thinks we're in a bubble. I mean, you can read what he wrote. It's a full-fledged epic bubble featuring extreme valuation, explosive price increases, frenzied issuance, and hysterically speculative investor behavior. Okay? It's not the first time he said this about this bull market. So once in a while, it'll give me pause, and I'll go, well, if the average PE in the market over the last 100 years is 19, and I'm buying this tech company whose PE is 100, or there is no PE because it's not earning money yet, maybe there's something to what he says. Maybe we are paying too much for certain stocks. Maybe we're overvaluing them. Now, when you have a bubble, let's just say he's right for a moment. When you have a bubble, it doesn't necessarily burst in 2 minutes. if you look at the 20s, if you look at 1920 through 1929, there were 8-9 good years of stock market before margin requirements kiboshed the whole thing. So I don't know what's going to, let's just say we're sort of in a bubble now that valuations are really extreme. I still don't know what's going to change that. What's the catalyst that's going to say, okay, we need to go back, PEs need to go back to 15 to 20. All these stocks are overvalued. Amazon overvalued, Apple overvalued, all this other stuff. So I don't know what the catalyst is to drive that when you have an accommodative Fed, when you have low interest rates, when you have benign inflation, and when you have tons of young investors who are interested in the market. So I listen to him, but I struggle with his philosophy. He's in the minority camp, but I do listen. I do like to read this kind of stuff, and I think it's important to see both sides of the coin. So if you're going to go out and buy a Sensius or Apple or Snowflake or any other stock you're going to buy, I would look at arguments on why to buy it and why not to buy it. And if you can go into, you can go into Reddit and do it. You can go into StockTwits and do it. You can call your broker and get 50 different opinions. If you have an account of Fidelity, you can go into the research function and get a bunch of opinions. And you might see something that makes you either want to buy it or want to sell it. So I think the more homework we do on individual stocks is going to make us better investors. Last thing about this little sector.
Hey, John, can I ask a question? Yeah. So where's this guy? Where does he think you should put your money? If we're in a bubble, what's his alternative? What's his?
So what he is, I would right. So as Casey says, he's in cash. He's waiting. He's waiting for this bubble to pop so he can buy everything. He did this in 08 also. Did the same trade. So he's probably short a little bit of stuff. He's probably getting hurt there. And he's probably just got a lot of dry powder. And if you look at his funds, the investors are really upset with this guy because his performance, it's negative. So you look at the other side of the spectrum, you look at Cathie Wood, who's, 100% returns last year. This guy was like negative 15% return. But he's waiting for his day in the sun. And so that's his philosophy. Always has been. If you go into GMO, though, and you read some of the things he's written, though, it's very academic. It's a little boring, but he is a bear. When you're done reading that, you're like, oh my God, I got to sell everything. Until you take a deep breath and realize, well, that's just one guy's opinion. Then you read Howard Marks, or you read Cathie Wood, or you read somebody else. You get the whole other side of it. Read Ron Barron. Tons of opinions, which is good. Make sense?
John, you said this guy is credible.
Oh God, yes.
You don't think maybe it's a one hit wonder? You got lucky the one time and.
No, he's done this a few times. He's really smart. He's got lots of followers. I'm not saying he's gonna be right or wrong.
I would just think if he's credible, I think the number one rule is that you can never time the market correctly. So what he's doing right now is completely off. Yeah. It's completely bad.
Right. For him, it's a trade. Right. For him, it's going to be this one fell swoop, like a 1929 style crash, and then he can pick up the pieces. I'm not smart enough for that, so I'm going to keep doing what I'm doing. But he's doing what he's doing. But that's why the market trades.
John, I have a quick question.
Get in there.
So if this guy's saying something like 2000 is kind of on the horizon, right? How would you approach this from somebody who's just getting their career started and has been investing for a few years? Would you just keep, dollar cost averaging every month, same amount of money every single month and kind of hit the highs and the lows? Or would you stay in cash for a little bit up until this thing pops? What would you do?
So what I would do is the same thing I've always done. I put the same amount of money in the market every month, high or low. I'm not changing my tune, and I'm not getting emotional about it. And I think so I don't listen to the person who says, oh, the Dow's going to 50,000. and I don't listen to him. I mean, I listen to them both, but I don't pay attention really. So the guy, okay, it's going to 50,000. Okay, well, you know, you're crazy. And it's going to like 10, 15,000. All right, you're crazy. And I think the way I look at it is that you have to be an optimist, not a pessimist, right? Which I'm always talking about. I mean, so in my heart, I might think about it, but I know, I doubt something like this is ever going to happen again. Unless the Fed radically raises rates, you know, we have a world war. I mean, there are black swan events that could move stuff, but I just don't see them in the short term.
John, can I ask you a question? One more
Yeah.
question. I think it'll be good for like a lot of older investors and younger investors. So, you know, with the market right now, you see a lot of guys and people, a lot of people saying that they think all these, you know, tech companies, growth companies are, you know, somewhat overvalued, right? And they're using like metrics like the PE ratio, looking at their balance sheets, you know, are they cash positive? What's their, you know, their loss? And do you agree that with the market currently, like, you know, the market is changing, those same old metrics are not the best way to value companies? And, you know, you have guys who are, you have people saying, you know, yes, use the metrics that like have been from the beginning, and some saying use it, but to an extent, you know, and some people are just staying away from growth stocks because they're saying, okay, PE ratio overvalued, I'm not going to buy it. But if you look at,
I think so. I'm going to respond to that. If you the first note I wrote in the morning thing today were these 3 laws that drive investment opportunity. So Moore's law is kind of a common law. Flatley's law, if you just look at these things, Flatley's law and then Wright's law, the way, I think one of the problems with technology is that it's changing so fast. And then when you look at the Flatley law about when you're doing these sequencing tests, think about it. The first sequencing test cost $2.7 billion. Last year, it was $500. Now it's $100. When you think about EVs and battery prices, $917 per kilowatt hour in the last decade, now $137, which is going to drop to $60. These are game-changing technological feats, I'm going to say, that are going to propel certain companies to greatness and certain companies to failure. So when I think about the PE of let's just say Tesla or NEO or the next 50 companies, the fastest is probably going to do the best in terms of stock price and gets battery costs down and stuff like that. I mean, how about the Tesla headline today? We're going to open showrooms in India. That to me, that's game changing for Tesla. That's a huge untapped market. But there's so many of these companies, right? And I'm not sure how to pick the right company that's going to win here. You're probably better off like in ETFs or mutual funds or something like that, like do EV or do genomic sequencing or do semis. You're probably, for us in this group here, you're probably better off like owning a diverse portfolio of it rather than one stock. But to your point, Case, you know, I think PEs are crazy, but I also think that if Amazon's going to grow at 30% a year for the next 10 years, I'd rather own Amazon than, you know, Hormel or Macy's or American Airlines, stuff like that. Or I'd rather own, you know, the bucket of Amazon or Google or Apple or a lower dollar price tech company, younger tech company that has this huge growth runway versus a legacy company that's struggling just to reinvent itself. So when I put my portfolio together, I do it two fashions. Because I'm an older guy, most of it's in income. So most of it's like I always talk about dividends, which are boring. Even my wife goes, stop talking about dividends already. But, you know, you look at Johnson & Johnson. If you own Johnson & Johnson for the last 20, 25 years, every year they raised its dividend. And by next week, they'll have raised it again. So if they're going to raise it every year between 5 and 10%, inflation's at 1.7%, and I bought the stock 20 years ago, and all I'm doing is capturing more and more income every year, that's a good thing. So that's one side of the blotter. The other side of the blotter, is going back to what you talk about. We talk about all the time, and that's growth. And I want to be in some stocks that grow. So is it Amazon? Is it Ascensius? Is it Vuzi? Is it all of them? But there's a bucket of that stuff too. And you've got to be diverse enough. So I think as you grow and as you get older, you got to be diverse enough either in mutual funds, ETFs, or stocks to capture both sides of the equation. And that's the trick, right? You can't have all your money in Apple. You could, but you shouldn't have all your money in Apple or Amazon or Essentia or Neo or Nikola, right? You need to own things like JP Morgan. You need to own things like maybe Bank of New York. You probably need to have a little crypto sprinkled in there just for, the potential that crypto, whatever it's going to be, I think it's more of a trade than an investment, but there's nothing wrong with owning it. NFT is a whole different ballgame, right? Even the guy who bought that big NFT, the guy who bought the Beppelman NFT for 69 million, he said today the whole thing's a bubble. He's also sold off this whole thing in pieces to other people, if anyone hasn't read that. So he put $69 million in this. He sold off this thing in little pieces, Bitcoin pieces, to all his the people that follow him. He has no skin in the game now on this piece of art. We'll call it a piece of art. I thought that was pretty interesting. But crypto, when you see and crypto, I don't know what to make of it other than when you see companies like Mass Mutual and Bank of New York and JP Morgan and all these companies are putting hundreds of millions of dollars into this thing. I think it's scary. It's interesting, but they obviously know something that I don't know. So,
John, did Jamie Dimon mention crypto? Revisit that at all, because he was so down on it like a year or two ago.
I think he's mentioned it over the last year. He's kind of changed his tune a little bit. I mean, Bank of New York, which is one of the oldest banks in this country, announced like 2 weeks ago they're going to be they want to be the custodian for all crypto, because it's a growth area, and custodial services at banks aren't growing. So that just gives it credibility for an older person. Oh, Bank of New York. Oh, that's good. I don't have to have my crypto at PayPal or Square. I can have it at Bank of New York now. Great. So it just adds credibility to the market. Now, could we wake up one day? Could Bitcoin be at 200,000 or zero? Oh yeah. And I'm sure you're going to see all these crazy prices over the next few years. But markets are markets. It's an opinion. We'll see what happens. I know some of my smartest friends are all buying crypto, which I think they're all nuts, but they're all doing it. So, and these are people that have been investors for 40 years. Pretty interesting. Keep going. Anybody want to chime in? So I thought this, just a couple things I wrote today that I just wanted to get to. I thought this UBS report about closing 80,000 stores was interesting. And they look at they talk, and you can read, I don't have to, repeat it verbatim, but it was pretty interesting how they talk about what kind of stores are going to make it, what aren't. They talk about the winners are Costco, Walmart, Home Depot, and Lowe's, which is pretty interesting. Costco we talked about last week or the week before. Very interesting company. They have the very low margins, but they have this, user fee every year they charge. Interesting company. I think they had earnings a couple of days ago, really good. Probably going to survive this thing just fine. You go into Costco. Yeah, love Costco, right? So Costco has their store set up like a treasure hunt. There's no signs on the aisles. You go in, and what they want you to do is explore every aisle versus a supermarket. And Costco, I think average items like 10 to 14,000. Average supermarket has 44,000 items, right? But everything's labeled, you know where the soap is, where the meat is. Costco, no labels. It's like a free for all. Go find it and have fun. So interesting. Just an aside about Costco. So I'm an investor in a little dog food company that has been trying to get into Costco for the last 5 years, private little company. If you have a dog, it's called, I'm going to give a pitch for it. Whole Life Pet is the name of this thing. They make human grade dog treats. Well, we'll get to Chewy in a minute. But this company, private company, you can Google it and see it, but it took this guy 5 years to get a tryout with Costco. That's how long it took for them to run him through the ringer, make sure his product was going to sell. And this is how Costco works with new products. They say, this guy's name is John. So John, we're going to send you $500,000. The whole company's called Whole Life Pet. So you're going to be able to find it in Costco in a month, but you can buy it online. You can buy it from Chewy, from Amazon. Whole Life Pet, and it's freeze-dried human-grade dog treats and cat treats. They also do CBD stuff. Anyway, so it took him 5 years to get into Costco. This is how it's going to work. He gets a check for $500,000 from Costco, and Costco says, okay, we need this amount of stuff on pallets. We're going to come pick it up May 15th. So $500,000 of product. And then Costco takes it to 30 stores. He doesn't even know what stores they're going to. And then 3 months after that, he's either told, your stuff's sold, or we'll never talk to you again. That's it. So it's this one-time shot. But if it doesn't work, game over. If it does work, then you get a check for $10 million. Now you're in every store. That's how they work with their vendors, which is pretty interesting. So I said, how are they going to advertise your product? He goes, they don't do that. It sits on a pallet in the dog food aisle. And people, like a treasure hunt, people have to figure it out. I'm like, sounds pretty risky to me, but that's their method. And obviously seems to work. And they love these young, you got to go through the ringer to get in there, but they love these young companies. So Costco's margin, though, is 14%. So the problem with young companies like him is they're paying him less and they're charging the consumer less. So if you go buy this thing on Chewy today, when you go to Costco a month or two from now, it's going to be a different price and a different size and all that other stuff. Costco always is the lowest price, tightest margin, better for the consumer. Chewy, which is another, there was a big article today, Morgan Stanley, big article today about the pet market and the pet market over the next 5 to 10 years. Really interesting. And so the pandemic, if you have neighbors, you may have noticed, like in the city where I live, in my little neighborhood, it's dog central. Everybody's gotten a dog. Lots of, these, what do you call them? Golden doodles, the doodles, because they don't shed. A lot of people have those. Why'd you get the dog? Well, COVID, we needed something to do, blah, 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 blah. But Morgan Stanley suggests that this is a fad, a trend. And if you have dogs out there, you know how much work this is, right? You got to walk them, you got to feed them. My dog's sleeping here, got to take them out all the time. They get old, just like us. But Morgan Stanley think this is just the start of a very long-term trend. So someone just brought up Chewy. When you think about Chewy, that's where we buy all our stuff. Easy, comes the same day or next day, nice and easy. Interesting stock to buy. Was at 20, went to 120. I think it's in the 80s now. I'd take a look at that one. Anyone shop at BJ's? How does people compare BJ's to Costco? I don't know BJ's.
It's the same.
Same thing.
Yeah.
Exact same thing. Same basic thing, I guess. Sam's Club, those kind of, they're all about the same thing. But yeah, same thing.
BJ's has their aisles labeled.
Has their aisles labeled?
Yeah, their aisles.
Yeah.
They're labeled.
Yeah.
Costco's the best deal because they also sell gas too as well.
Doesn't BJ's do that?
Do they? I don't know. I'm not sure. BJ.
I think they all do it now.
Yeah.
It depends on location.
Yeah.
Costco here doesn't sell gas. It just depends, I guess.
Sam's Club is great. They offer a curbside pickup that they've recently been building up, and my family gets it probably once a week. And they even give us additional free items for like kind of incentivizing us to keep using it.
Who owns Sam's Club though? Walmart?
Yes.
I think Walmart, yeah. Yeah, Walmart, interesting company, Walmart. Interesting. These companies, you know, we haven't focused too much on these big cap companies, but interesting stuff.
Yeah, John, let me just jump in on retail
Yeah,
real
get in
quick.
there.
So you guys have all read, stores are going away, et cetera, et cetera, et cetera. And we get that. But what's really interesting, and you guys all shop online, it's really interesting. If you go on and pick John's dog food thing, whatever it's called again, if you go on Chewy, you go on Amazon, and probably if you go on Walmart, if they carry it, it'll basically be the exact same price on all three of those, right? They all have the algorithms, they all price match each other. Once in a while, a guy will say nickel off, and they all go nickel off. But when it comes right down to it, for anything you buy, there's probably 4 or 5 major retailers in this country, all online, all at the same price. So when you think about it, there's probably a huge opportunity over the next 3 or 4 years for all these guys to gradually increase their margins, right? I mean, if you go down the street and you go to a corner that has 3 gas stations, shockingly, they're all within a penny of each other and they're all making decent money. It's a little bit of an oligopoly out there. And I actually think the elephants are going to gradually make more and more money on margin because they all have pricing power. And it's not a lowest common denominator where they're trying to put the retail guy out of business because they're already out of business. So don't run away from these big cap guys because they might just keep getting bigger and bigger and increase margins at the same time.
Yeah, someone talked about that woof somebody was talking about. That's not an ETF. That's Petco. So I don't. There is an ETF for pets. I forgot what it is, but the stock somebody was mentioning in the chat room, WOOF is not an ETF. That is what used to be Petco. It's now called Petco Health and Wellness.
The pet ETF is PAWS, PAWZ, I guess.
Yeah, so
It's the first one that pops up.
PAWZ, if you want the ETF. The problem I have with Petco is it's run basically by private equity people who are not. They could be running a widget company. They don't really care that it's a pet company or not. And pet companies had its starts and stops time and time again. When you think about Chewy, a company like Chewy, if between one or the other, I think Chewy's probably a better thing to take a look at. Just if you're leaning that way. And then, also, and just while we're on pets, pet healthcare, pet medicine, things like that, huge. There's this company called Zoetis, the ticker ZTS, which is done very, very well. And it's all about pet meds and stuff like that. There's Pet Med Direct, all sorts of other little companies here that if you want to play the pet, if you think this is going to last for 10 years, some of these companies can do very well. So, we'll see what I'll report back in a few months on Costco. We'll see how he did. But he just got into pet. This guy just got into PetSmart and Costco. But to Steve's point, as time goes on, he's selling less and less in smaller boutique dog stores, and I think those places are going to have a big problem. What's up, Patricia? Oh, it's got a big facility by FDU. Yeah, Zoetis is it's a company worth taking a look at. It's a serial dividend increaser. It's nothing, it's probably nothing we would have heard about. It's not mentioned on, Kramer every day, but it's a steady, grinding, growing company in a growing industry with a big moat. So those are the kind of companies that, I guess when you go back to Casey's point, if a company's in the right industry, if the industry is growing, if it has some kind of moat, if it's got good management, I will pay an above market multiple for it. And I look at that all the time. Yeah, I said dividend again, I know. But I also, going back to one last thing about these companies, listen to management. When I listen to Jamie Dimon, or when I listen to whoever runs Costco, these people are really, they're passionate about their business. Okay, so I can't read that. What's up?
I was just asking any thoughts on the next company to enter the S&P 500, next big company. What are your thoughts on that? I think I'm looking at more Square, Zoom.
That's a good question. I don't know the answer to that. I have to think about that.
If you look at market cap, I think Square is right up there, comparable to the companies at the bottom of the 500.
Yeah.
So you look at the the market cap of the companies that are just outside the top 500 and probably look to one of them.
You know what? I haven't even thought about that. Huh. Sorry, I have to send a quick message here. Huh. You know, I think when things go into these indexes, a lot of the mutual funds and the index funds have to readjust everything. But I don't know if it's a major deal.
Yeah.
I don't know.
John, I've looked at this because, Vanguard has an extended market mutual fund, which is everything beyond the top 500, the S&P 500. So you look at the top holdings there, that mutual fund, and it gives you a list of the next candidates.
Oh, okay. Okay, I'm
Yeah.
gonna take a look at that. That's interesting. Huh. All right, a couple other things, because anyone want to talk about anything, or should I keep going? So I talk about Kathy Wood a lot. She's the ARC woman, really great, futuristic kind of investor. She has a new ETF that came out this week, ticker's ARKX. It's all about all the space companies. So if you want a little outer space, if you want a little space exposure, I think it trades around $20 a share or something like that. You may want to take a look at that. This is interesting. So I was reading about Bill Huang today. Bill Huang is the guy at Archegos. He's been in the paper like every day over the last 5 days. He's the guy who was involved with Viacom and Discovery, GSX, Shopify. He got a big margin call last week. You know what I'm talking about? It's been in the paper like every day. Anyway, he was he worked for a hedge fund called Tiger, spun himself off. Now he works for a family office. One of the things I didn't realize that margin requirements for family offices and hedge funds are different than for me and you, a lot more lenient. Anyway, so he got a margin call on Viacom. This is like about 8 days ago. And the stock went from 100 to 80 to 40, which basically put him out of business. But he had to sell all these other stocks that he was long, Discovery, GSX, Shopify, Baidu, all these other things. But I just wanted to quote one of his quotes. This is what was a quote from him today about his investment strategy. Okay. So this guy, he was worth $20 billion last Wednesday. Today he's worth zero. Literally 20 in a week. I think the worst performance of all time. Lives in Tenafly, drives a Hyundai, very unassuming guy. You know what I'm talking about? His picture's been in the paper like every day for the last week. Anyway, this is how he invests. Ready? And I'm quoting from him, so don't yell at me. I try to invest according to the word of God and the power of the Holy Spirit. I'm quoting him, and I'm not, and he has this big religious side to him, gives a lot of money to charity, basically a good dude. But I guess, whatever happened, and $20 billion went by really quick. But when I read that, I didn't chuckle, but I just went, aha, so that's how he's picking his stocks. Pretty interesting, or not interesting. So we'll throw him in the mix with Jeremy Grantham and Kathy Wood and all these other people. And, that's the market. So what about you want to talk cruise ships? What do we think about cruise ships? What's happening there? How much more capital do they have to raise, Case?
I mean, I saw on CNBC that Florida is trying to sue the CDC. I think CDC,
because
they're trying to
they want to cruise earlier, right?
Yeah.
Because every day they don't cruise, they waste $30 million in gas and upkeep and everything else. You saw what I said on AMC last week, right? When AMC sold another half a billion shares.
Yeah.
I think the recovery is a little slower than people think, and I think you're going to see more and more share sales as some of these companies are forced to raise money just to keep the doors open. I mean, every day a cruise ship doesn't cruise, they're not making any money. No one's buying a pina colada on the boat, right? That's a problem. Now, speaking of that, I put out a little blurb on the dream. You know, everyone, most of you are from New Jersey, so you're aware of the Dream Mall, which is by the Meadowlands. So if you're a Jersey guy or gal, that thing has been a jinxed property for, I think, the last 30 years. It's been, right, really big mall after mall. It's all, the new owner, well, who was the new owner 5 years ago, was the same owner who owns the Mall of America in Minneapolis. That was the first concept of this type of mall. Restaurants, you know, ski lift, all this crazy stuff. Anyway, he's had a tough time because the mall hasn't been open. And 2 weeks ago, he got a margin call and he had to exchange because he couldn't pay the interest on his debt. So JP Morgan and Goldman Sachs equitized his debt, and now they own about 30% of this mall, which is still not, as far as I know, it's still not open. So what's the question, Case?
It's open. It's
It's
open.
open? I don't know the number of how much he had to put in to pay the interest, but you know, he just gave away, if the thing ever comes back, he just gave away probably half of his ownership in that thing. I don't know. I walked through the Columbus Circle Mall a few minutes ago before class, which is right by Central Park. It's got all these fancy stores. Somebody was talking about, there's a Lululemon, there's a Whole Foods, there's a Vineyard Vines, and then there's like a Hugo Boss and an H&M and all these other things. So it was 2:30 today. So it's Thursday, 2:30. Nobody in there. Nobody in there. So I'm doing my little, you know, my test, like, well, who's buying a $1,000 shirt at Hugo Boss today? Well, nobody. Who's at Lululemon? Well, nobody. And, you know, high rents, great location, but I really question if that mall is going to be in the same shape it is today, a year, 2 years, 5 years from now. Don't know. So as New York City, I'm sorry Arcadie's not on today, because New York City, the city, I got to tell you, the traffic, there's tunnel traffic. You can't get reservations at restaurants, but it's spotty too. There's still lots of vacant storefronts. Do I think a bailout's deserved for what, Case? For the city?
No, for the guy with the American Dream Mall who struggled.
Absolutely not. Oh, you think we should bail him out because he's a good dude?
No, I was just curious to know your opinion on that.
It's not a nonprofit. It's a for-profit company. He's owed JP Morgan and Goldman Sachs millions of dollars for months. So, you know, it's been like, okay, well, it's like a landlord. Let's wait till next month. How you doing? I got nothing. Well, okay, now it's time that we're an owner with you right now. And they don't want to do this. Believe me, they don't want to do this, right? The last thing JP Morgan knows is how to run a retail mall in North Jersey. And the last thing Goldman Sachs wants to do is be involved with this at all. But it's going to be the easiest way for them to get paid back on their investment. And the owner's going to keep struggling. I haven't been in the mall, but my guess is it's going to be a struggle until everyone gets vaccinated, people are more comfortable, you know, all that stuff reopens. So in the end, probably work out, but I don't know how soon that's going to be. The other thing about, again, a lot of people in the city are reallocating office space, but I also think a lot of people in the city want their people back in the office sooner than we thought. So JP Morgan's talking about September. I know my son works at Barclays. They're talking about September. Where 2 weeks ago, they were talking about next year or never. Now they're saying, September. You're all vaccinated. You know, we work better. We're in a group, particularly Wall Street companies, banks, investment banks. You know, you want people in the office, basically. So I think that all that's happening sooner. I know the price of apartments is going up. Rentals, there used to be big discounts on rentals. That's all ended. The building I'm in, which was probably 30% vacant, is now full. You know, like all these fancy apartments sell really quickly now. ESRT, I don't know, we doubled our money. How's it doing? I haven't looked at it in a couple of days. That was a double from last. So with Steve Weiss, you doubled your money in, 35 days. With me, it took 12 months. But I think the, ESRT, I want them to reinstate their dividend, right? To me, it's not just about price appreciation. If I'm going to stay in a stock like that for a long time, I want cash flow. I want quarterly cash flow. So that hasn't happened yet. And although I see more tourists, I don't see, I haven't seen the numbers from the Empire State Observatory yet, which is literally a big part of their monthly cash flow. So as soon as we see that, we'll have a better look. I'll look at that for next week. Anybody else? All right,
I have a question.
get in there.
So you've been in the stock market game for a long time. How much companies would you say like you've seen like go down under in the stock market like year over year?
Year over year?
Yeah.
It kind of depends on the year.
So like
So like when you look back at 07, 08, you probably think about banks. When oil prices go up or down a lot, you look at energy, that kind of stuff. But remember, when companies go Chapter 11, they don't always disappear. Like Brooks Brothers went Chapter 11, yet Brooks Brothers is reinventing itself. And a lot of companies, they use the tax laws to get out from under their debt to try to get back to doing business. I mean, let's talk about Hertz for a minute. Hertz, we talked about Hertz, I don't know, 6 months ago. The stock was at 5 when I think we all said to each other, well, wait a second. If the bonds trade at 30 cents in the dollar, the stock is worth 0. And lo and behold, last week, Hertz, which went into bankruptcy, accepted a plan from a private equity company called Centerbridge, and the stock is 0. And all the bonds now are equitized into equity. So Hertz will live on. And I think that's sort of interesting. Vic, what's the question? Capitalize on what? I can't read it. What did capitalize on what?
SARS-CoV vaccines.
Yeah, you know what? I mean, you think about Pfizer and Moderna. I guess you see them, but I think you're better served in biotech looking away from the vaccine, looking at other things they're working on. I think this vaccine, we're going to wake up in 6 months and we're going to go, all right, now we need a new vaccine, right? Because the variety has changed this thing so much. Everyone needs a booster shot of this. There's going to be a bunch of companies doing it. I don't think they're making a lot of money off this stuff, though. I think you're better off looking at companies that, they could cure Parkinson's, cure Alzheimer's, do biogenetic testing, that kind of stuff. And to Jonathan's point, there are so many biotechs, like literally 5 or 6 go public every week. It's probably better off to buy one of the ETFs rather than take single stock risk. They are so volatile. So I think it's BBI is probably a good one to take a look at, or IBBJ, maybe those two rather than buy single stock biotechs. All right. Anything for next week? Anything people want to talk about? Email me. We'll get on it, or we'll continue on in the same vein.
Sounds good.
Go out, enjoy the rest of the day. It's gorgeous out, and stick to your plan.
Thanks, John.
See you guys. See you, ladies.
All right.
Bye.
Take care, guys.